Hello there, everybody. How are we? Can you guys all hear my voice and see the screen right now? If you can, just give a little shout in the questions box here. Hello, 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 hello. Great. Okay, cool. So for today, we're going to be talking about trading catalyst events with less risk using binary options. And I think this is a really cool topic because everybody out there wants to be able to trade catalyst events. Most traders, and you can tell this and you know this because it's something that they rattle on and on and on about on CNBC, on Bloomberg, and other financial news networks. Catalyst events create big opportunities for traders, but can also create the opportunity for large outside losses for those traders who don't approach them with proper risk management. It can be difficult to do that with futures or stocks or even standard equity options. But with binaries, this whole process of knowing what my risk is, setting up a trade that will profit if my particular thesis is correct, is very easy to do. We're going to talk about some of the binary options basics. I would imagine that most of you probably have at least some idea of how these things work. How many of you here have never traded a binary option before? Even if you haven't, we're going to go a couple of slides of review here, and then I'm going to go over an example trade setup here in the slides, and then we're going to be able to go through some live. And what I'm going to show you guys is how I can use the standard options on futures markets to develop price targets in a week where there is a catalyst. And we're just going to say that Friday is a catalyst for us. We know that it's not really, like, there's not something that's going to happen at the inauguration that is going to be material to the price of the market in the short term. But because we have a standard Jan expiry, we can do this type of setup and analysis in a whole bunch of different indices and kind of look at different trade examples in weekly binaries. So the second half of the presentation will be us going over the setups in the actual platform. All right, so we're going to jump in here, and before we do, I'm going to read a couple of risk disclaimers. Trading on Nadex involves financial risk and may not be appropriate for all investors. The information presented here is for information and educational purposes only and should not be considered an offer or solicitation to buy or sell any financial instrument on Nadex or elsewhere. Any trading decisions that you make are solely your responsibility. Nadex instruments include forex, stock indexes, commodity futures, and economic events. Nadex binary options and spreads can be volatile, and investors risk losing their investment on any given transaction. However, the limited risk nature of Nadex contracts ensures investors cannot lose more than the cost to enter the transaction. Nadex is subject to U.S. regulatory oversight by the CFTC. And here's our risk disclaimer, pretty much the same type of thing. I'm not going to read the whole thing, but just glance over this really quickly and be aware that everyone viewing this presentation adheres to all disclaimers on optionhacker.com and alphashark.com. My name is James Romelli. I'm a trader at alphashark.com and our head options educator. I actively trade stocks, options, binary options, and the occasional currency pair. But I'm on CNBC, Bloomberg, Fox Business, BNN Canada pretty often. If you haven't seen me on TV, maybe you've read something that I've written. I write about binary options for a number of different publications and about equity options for a number of different publications as well. So enough about me. We're going to talk about our plan for the presentation today. We always start our presentations with this exact same quote. If you want to be more powerful in life, educate yourself. It's that simple. And that's true when it comes to trading, probably more so than most things. There's always new developments. The stock market, futures market, commodities markets, currencies markets are not static. They change. They're dynamic. Things that work today might not work tomorrow. Things that work tomorrow probably wouldn't work today. But when we have the ability to widen out our tool set, meaning learn new products and ways to approach trade setups, it makes us more flexible as traders, and it's always a good thing. It's never a bad thing. So with that spirit, we want to talk about different ways to approach catalyst events using binary options. And when I'm talking about catalyst events, I'm really referring to risk points in the market. Someone name for me some macro catalyst events that happen on a regular basis in the broader market? What are some things that we would consider macro catalyst events that happen pretty often, at least once a month? There's one that I'm thinking of right away. Yeah, FOMC, that's a good one. Jobs number, crude number, crop reports. Yeah, all of this. Rate decisions overseas. Yeah, central bank actions overseas as well. Significant impacts on currency markets. So there's a lot, right? The market is never really lacking for catalysts for an extended period of time, right? If we were going to say that there was a period of time where there is no catalyst, it probably would have been, towards the end of the year, the holidays that we just got through. That tends to be a pretty quiet time, but we are coming into a part of the year here where we're going to be getting catalysts on a regular basis again. There's a lot of attention being paid to FOMC, so I think it's a good time to master different ways to trade those types of events. So binary options are going to be our focus for today in trading catalyst events, and binary options are pretty simple contracts in general. When we're talking about options, people usually tend to I don't want to say glaze over, but people usually get intimidated if they're not familiar with options, because options are generally considered to be complex products. And binary options are a derivative, but they're relatively simple to understand. It's a simple yes or no question that a trader is asking themselves when they put on a position. Nadex defines them like this: a security that asks a simple yes or no question: will the market be above this price at this time? If I think yes, I buy the binary option and it settles at 100. If I think if it doesn't close above that price, it settles at 0. Okay, so I can buy or sell binary options with a kind of finite line in the sand level where the trade will profit or not profit for me. And what's nice is that because they're bounded in the payoff structure, meaning it can't be worth more than 100 or less than 0, no matter what I do at any given time, I know exactly and with certainty what my risk and potential reward is in a particular trade setup. Okay, so the binary options settle with a value of $0 or $100. I can buy and sell them for some price in between that $0 or $100. Contracts are standardized and settled the same process regardless of the underlying market, which is completely different than the way the futures options market works. Futures options have a ton of different ways that they settle. Some settle in cash, some settle in physical, some settle in the future, and you have to know that. Binary options are much more simple in that regard. But this provides me access to a number of markets that I might not have been able to trade otherwise. Who here trades commodity futures? Give a shot if you trade commodity futures. Here, this is a better question. Who here would trade oil and other commodities, gold, if you had the capital to do so? Because I honestly believe that for someone to trade oil futures intraday, I mean, the amount of capital that you would need to have to do that comfortably is pretty large. It's not a small amount of money. Yeah, pretty much everyone would, right? Everyone is at least interested in trading those markets, but they are expensive to trade. Because the contracts for binary options can't be worth more than $100, I can trade crude oil with the same amount of capital that I need to trade the Nasdaq or the S&P. So this makes binary options ideal for trading catalyst events, because when we talk about catalyst events, we understand that the risk ahead of those events is larger than it is on a normal day. So if I don't have the capital to trade oil futures on a normal day, I certainly don't have the capital to trade oil futures on a day when that risk is increased because of some catalyst, okay? So binary options are the same regardless of the market. We're going to look at the contract specs for the CME, E-mini S&P 500 futures. These are what we would call the US 500 binary option. So here we have an example. It's a slightly older example, but the futures are trading at 2077. If I buy the US 500 greater than 2080 daily binary option for 40 bucks, what I am saying is that I expect the US 500 or the CME E-mini S&P 500 futures to close above 2080 on the expiration of this option. Doesn't matter how far above it closes, if it closes 1 point above 2080 or 200 points above 2080, the option is going to settle at 100. Again, it doesn't really matter where it closes to the downside. It can never be worth less than 0. So since I paid 40 bucks for this, the most it can be worth is 100, the least it can be worth is 0. My maximum risk is $40, my maximum reward is $60. So I'm getting a good reward to risk ratio here, right? 1.5 to 1 on my money, and all I really need is a bigger than 2.5 point move to the upside. How tight would my stop need to be for me to get that same type of return potential in the futures? It would have to be very tight. I'd get chopped up very easily. But this is pretty simple. So this is a good way that I can take a simple idea like I think we're going to be higher after the FOMC announcement and translate it into a strategy that I don't really have to worry about slippage or my stops getting jumped or anything like that. It's just going to give me a fixed profit and potential risk at the beginning of the trade that isn't going to change, okay? So, oops, sorry. The contract size and restrictions make this something that lends itself really well to trading these catalyst events. The contract sizes are small no matter what market, or the same no matter what market. I can trade oil with the same amount of capital that I would need to trade anything else. This is very different from options on futures or index options. If we were to go and I think this is all right. I'm going to show you guys the options chain here for a couple of futures contracts, and you can see just how different they are compared to binary options, which are much more simple. So here we have the options chain for the E-mini S&P 500 futures, and as you can see, they trade with a tick multiplier that is a certain price. So if I buy a contract for one contract for $1.15, it's really going to cost me $57.50. Now, if I go to something like crude oil, the tick multiplier is completely different. If I buy a one lot for $1.13, my maximum risk is now $1,130. So as you can see, the value of the ticks in all these different options is very, very different. Those are two options that were quote unquote the same price, but one of them is 25 times more expensive than the other one. So when I'm trying to trade all these different markets and I have a small account, it can be difficult to manage those larger positions like something in crude oil. So when I want to trade all these different markets, having a standardized set of contracts like Nadex gives us with binary options is really, really helpful. I can open up an account for as little as 250 bucks, and in general, when we compare different markets to their corresponding options market in the futures, we know that I'm going to need way less capital to trade binary options than those options on futures. Now that doesn't mean that this is useless. As a good binary options trader, I should really be paying attention to these options markets, and I'm going to show you why and how. But I can use these options markets that I don't really want to trade to get information that I can then use to set up my binary trades. So we're going to go over an example here now in the slides, and then we'll go over several live examples. But before I jump into the example in the slides, does anyone have any questions about anything we just talked about up to this point? Any questions, guys? Okay, perfect. So most traders that have traded binary options or are familiar with binary options focus only on the intraday aspect of binary options trading. They consider them to be really short-dated instruments that are really not useful for much more than taking intraday speculative positions on different indices, different commodities and such. That's actually not true. Nadex, and I don't believe that there's many, if any, overseas brokers that offer weekly options, offers weekly binary options. So I can actually set up short-term swing trades using Nadex. So the examples that we're going to go over here from this point on are going to be those short-term swing trade types of examples. Before I set up one of these swing trades, I have to have an idea of what the movement expected in that underlying market is. Once I have that idea of expected movement, I can then calculate a price that I can then use to find a good strike price for a binary options trade setup. We're going to do this by using the standard options market and straddle prices for at-the-money straddles. Okay, so for those of you that are not super option savvy, an at-the-money straddle is simply the price of the at-the-money call plus the price of the at-the-money put. Okay, and we can look at those prices across any expiry we want and figure out what the market makers are pricing into the underlying options in terms of expected movement. So let's look at an example right now. I know that kind of sounds a little confusing, but here we have an example in NASDAQ. And this is an example from over the summer. NASDAQ futures are trading around 44.50. I want to figure out how much the market is expecting them to move by expiration. In this example, we were looking at June expiry. That was the front month expiry in the same week. The 44.50 straddle was trading for 59 points. So what this means is that right now the market maker is selling to the rest of the public a 59-point straddle as their expected movement for the time between now and expiration. So to calculate an upside and downside target, all I have to do is add that 59 points to the price that the market is trading at now and subtract that 59 points from the price the market is trading at now, and boom, I get an upside and downside target that I calculated using the standard options market. Now that I have those in mind, I can look for binary options trade setups. In this example, I look for a bullish and bearish trade setup, but this is just kind of to illustrate, how I would do this. In reality, I would probably have some type of directional bias and would pick one of these, not both of them, and in that situation would be hoping for a directional move. But this is the strikes that I would use for either of those two ideas, whether or not I think the market's going higher or whether or not I think it's going lower. That calculated target is going to help me figure out what strikes work best for a binary options trade. So remember my upside target of 45.09. In this particular case, I could buy the US Tech 100 4500 strike weekly options for 75 bucks, or for 25 bucks, sorry. In that case, I only need the market to move to above 4500. Remember, my upside target was 45.09. All right. So what that means is that I don't even need the market to move the market maker's full expectation. All I need for it to do is to go above 4,500. Does that make sense to everybody? Are you seeing that? All I need for the market to do is go above 4,500, and this will pay off at a 3-to-1 reward to risk ratio, right? I will make $75 from my $25 in risk. So what I've done is used the market maker's expectation that they're pricing into the broader or the standard futures options to calculate calculate an upside target and then translate that into a binary options trade setup. Now, if I wanted to get short the market and play that downside target, which remember, 43.91, I could sell the US 100 4,400 binary options for $75. Now, rather than buying the option, I've sold it. I've sold this option. So what that means is if the market closes above 4,400, the option will go to $100 and I will lose 25 bucks. Sold it for 75, becomes worth 100, I lose $25. Now let's say the market sells off to the market maker's downside target of 43.91. Well, remember, anywhere below 4,400, this option will settle at zero. So I will collect the $75 in premium that I sold the option for. At no point was my risk greater than 25 bucks. So just like the trade right above this, I have a short setup that gives me a 3-to-1 reward to risk ratio. And that's so important. How often do I need to be right if I'm getting a 3-to-1 reward to risk ratio? Not nearly as often as I would if I was, making even money on every trade. If I collect this premium or this profit of $75 by selling this option because the market moved lower, all I had to risk was $25 to do that. And what I've done was used the underlying options in the market to figure out these levels, right? So trading binary options versus futures and stock doesn't necessarily help a trader smooth out the volatility in their returns. Because of the way that these options settle, that either go to 0 or 100, my returns can be a little more volatile on a trade-to-trade basis. But because I'm getting such a good reward to risk setup and a superior risk management setup, I'm able to say that this is very much worthwhile for me to do, right? So I want to go over some live examples here using the Nadex platform and my options platform. So can you guys give me some indices that you would like me to kind of run this type of setup in? We'll start. Maybe we'll just do them all. I think that would be a good way to go about it. There's weekly options for pretty much every major U.S. index here. So let's kind of start going through some of the examples, and we're going to start with the E-mini S&P 500 futures. Okay. So the first thing I need to do is figure out how much the market is going to be expecting movement-wise between now and expiry. So where is the market right now? 2261.75, 2162. It's in between strike prices. So what I need to do is figure out what they're implying here. I can take what's known as a strangle, which is a at-the-money call and at-the-money put. In this case, the 2260 puts and the 2265 calls, and figure out what they're implying between now and the end of the week. And it's 11.25 points. It's called 11 points on 2262, okay? So what that means is I have an upside and downside target that I can calculate. 2262 is where we're trading right now. If I add 11 points to that, I get what? 2273. If I subtract 11 points, I get what? 2251, okay? So these are now the levels that I'm going to use to try and set up my binary trade. I can look for trades that would make sense depending on my bias. So which one do you guys want to do first? Are we more bullish or bearish the market this week? What do you guys think? Is the market going to rally or sell off by Friday? What do you think with the inauguration on Friday? What is our opinion? I think the market will move higher, but not in a huge amount. But take a look at that. I mean, that's just a useful piece of information to have in general if I'm trading binaries or anything else. If I go ahead and take a calculation of that expected movement and say it's 11 points, well, then I'm able to take a look at all my trades and see whether or not they line up with the market maker's expectations. I shouldn't be looking for a move of 20 points this week because no one is expecting that. So let's take a look now at the binary trade setups that I could find. Now let's say, for example, that I was bullish. What would I do? We'll do this first, and then we'll go over an example that I could use if I was expecting a sell-off. So I'm going to go to the weekly options, the weekly binary options. And I'm going to get my ladder chart. So remember, my upside target calculated using the underlying options in the futures market is 2273, okay? I might actually log out and log back into my thing here. Hang on one second. I don't know why it's not loading up, though. So my goal is to find the contract that gives me the best reward to risk ratio while still considering that market maker's target, okay? So to do this, logging back into my platform. So to do this, I'm going to pull up the ladder chart so I can see all of the strikes at once relative to the chart setup. So since we're looking at E-mini S&P 500 futures, I'm going to look at the US 500 weekly options, because one really important thing to note about that calculation that we did, the 11 points in movement that the market maker is expecting, that's their expectation for movement between now and expiry. So movement between now and expiry, I'm really only going to be able to capture all of that using weekly options. Anything with a shorter dated expiry, like an intraday thing, isn't really going to give me the ability to play that expectation, okay? Come on, ladder chart. Not sure why this is so slow. Something's been up with my computer here. I also have quite a few things running in the background as well. Wow. Okay, there we go. So remember, my upside target, this doesn't look right. So I guess I won't use the ladder chart. This is my computer's fault. So my upside target, remember, is 2273. So let's just look at the chain right here. So which of these options is going to give me the best reward to risk ratio while including that 2273 level to the upside? Well, what I have here is a 2279 half. That's too high. We're not expecting the market to move that high according to the market maker. I've got a 2267 half. That is the level that the market maker is saying could actually be possible. So let's say that I wanted to go ahead and put these on. I'm going to bid 40 here. Now if I get filled in this position at 40, and I just did, all I need to happen is for the market to move above 2267.5 by the end of the week. Now the market maker has already told us via that straddle price that were the market to rally this week, they could expect it to go as high as 2273. The market is at 2262 right now. So all I really need is for the market to rally more than 5.5 points, less than half of what, or right exactly at half of what the market maker expects it to by the end of the week. If that were to happen, these options would be in the money and go to max value. And I would get a $60 profit on a $40 level of risk. I know that was kind of disjointed because of the technical issues there, but did everyone follow along with that trade setup? Because I would do the exact same thing if I was looking for a bearish setup. My downside target that I calculated was 2251. So I have to find a strike that includes that, but still gives me a good reward to risk setup. So what do we have? We have a 2243 half, right? Market maker is saying that probably is not going to move that much this week, but I have a 2255 half that I can use, and these are actually trading at a pretty nice price here. I'm going to offer these out for 65. So now if I get filled there for 65, all I need to happen is for the market to move below 2255 half. Remember, they're expecting the market to move to 2251 if it were to sell off. So a lot of the questions that I get from people about trading binary options all have to do with selecting strikes. How am I going to find a strike that makes sense for my thesis, my market thesis? And this is a really good way to do that, okay? Now, I don't know if I'm going to get filled in that level, but let's go over another example here. So this is a good week to kind of look at these types of setups because it is a standard serial expiry for futures options. So if we wanted to look at something like the Nasdaq futures, that's a good question, Enrico. I'll get to that in 1 second. So the market's at 50.38 quarter, 50.38.75. We're going to look at the 50.40 straddle. It's trading at 34 points, okay? So if the 50.40 straddle is 38 points, we have a 50.78 upside target and a, I'm sorry, 50.74 upside target. And to the downside, we have a what? 5,006 downside target. So with those targets in mind, I would then go to my options, go to my weeklies. To play the upside, 50.74 is my upside target. Look at that. There is a binary option that lines up with that perfectly. So here, by doing this, I would look for the market to trade up to this level or a little bit above it. You know, if I could get these for 25, I could then take profits early if that move happens on the open or throughout the day on Friday. They'll be worth more than 25. Someone said, do I always look for them to expire in the money or do I take profits? No, I don't always hold them to expiration. In risk management terms, it's actually not a very good way to manage any position or trade in anything, especially binary options. You know, if I saw, and you know, for these examples, I just did one lots for you guys, but typically I'm trading more than one contract. If I see, you know, a contract that I paid 25 for move to 50 or 60, well then, yeah, I'm going to be taking profits in some of the position. Absolutely. That's just a good risk management technique. Because think about it like this. If I buy these for 25, my risk is 25 at the onset of the trade. If they move to 50, my risk is now 50. It's twice as much as it was when I put the trade on. I'm profitable, but I have more risk in the position, so it would make sense for me to trim that up. So let's take a look at our downside target. 5,006 is the downside target. There isn't really an option that lines up all that well. So when that is the case, I looked for an option that is as close to the line level as I can. In this one, it'll be another case where I can sell them for 65, but would still only need the market to move less than what the market maker is expecting. They're looking for 5,006. That's a 5,014 strike option, and I just got filled in that one. So easy way to pick targets using the straddles from the options on futures markets. Definitely something that is handy when you're trying to find swing trade targets. Dumb question: of the market makers right a higher percentage of the time? No. So what we use the straddle for, the reason that we do it is because the market maker is setting the price of volatility. So if we want to have a really good in real time expectation calculation, we use their prices, because supply and demand and what the market is setting broader volatility at is what sets the price of those options, right? So if I want to know or gauge expectations for movement, that's what I want to use, rather than some technical or chart-based, chart-based method. Does that make sense, though, Gary? The real-time buying and selling of options is what sets those prices. Like, so the entire market comes together and decides what this is. The market maker is the one making the market right now, but they make their markets based on supply and demand. Okay. So there's two examples. I wanted to leave time here for questions, but also I want to give you guys a chance to get something that we have to offer for you today. We have a book on technical analysis and the Ichimoku Cloud. So check it out here at this link, alphashark.com/geese2016. It's a really, really great book. We didn't get into the cloud too much here, but for trading binary options, this is a fantastic technical indicator to have knowledge of. So please check it out. But what I want to do now is kind of leave the rest of the time open here for questions. If you guys have any, so just kind of let those roll in. This method of using straddles to calculate moves, it's something that I use every day for trading equities and for developing targets for binary option setups on a swing trade basis. Someone says, isn't it more effective using Nadex spreads rather than binaries? Also, if we don't hit our target, binaries lose their entire value. Spreads leave a consistent residual value even if we do not hit our profit target level. So is your question, I guess I don't really understand your question. Are you asking if it would make more sense, a spread straddle? So basically it's about risk versus reward, right? Spreads are a fantastic product. Nadex spreads are great, but I think they lend themselves well to intraday setups or some types of swing trade setups, but I can't manage the risk as effectively or as easily in those trades as I can with the outright binary options. Let's take a look at a spread. You know, rather than having a really fixed level of risk and reward, you know, where I'm risking 25 bucks per one lot, you know, there might be spreads, and also there are no weekly spreads, so that doesn't really work for the trade setup that I just went over. But they tend to be a little bit wider. I mean, this is 10 points wide, 40 points wide, 40 points wide, 30 or 40 point wide spreads. That's a lot more risk than the binary options let me take on. If I know my risk and reward and I'm fine with that at the onset, then it doesn't really matter to me if the trade goes to zero. If I know I'm risking 40 and my max reward is 60, if I lose that 40, if I'm comfortable with that, then it doesn't matter to me if it goes to zero, because that was my risk and reward at the onset of the trade. You know, if you're trying to compare trading straddles and the options on futures market, that's never going to have the same risk to reward setup. You would need an insanely huge move to get a 3-to-1 or even a 1.5-to-1 reward to risk payoff on a long straddle or strangle in the outright options market that trade on those futures. Make sense? So any other questions, guys? Any other questions? Comments? Concerns? If you guys want me to go over anything else, I can as well. But do we all understand, is everyone clear on the method here for that I use to calculate these expectations and then translate them to a trade setup? For those of you that are, strictly day traders, that probably isn't going to be that useful of a trick. For those of you that do trade overnight and trade weeklies, that's going to be a extremely useful trick for developing price targets. And one of the things that I do as well is, I'm not a huge technical analysis guy, but I do look at some indicators, and a lot of times when I calculate those expectations, I'll wait to see if I can get a level that lines up well with one of my other technical indicators, and then I think it's a really strong one. Are books available on the website? The book, you can get this book for free right now at this link, Gary. So you can go to this link here, alphastart.com/nadex-dees2016. You can click it in the chat box or out of the questions box here. Any other questions, guys? Any other questions? Any other questions? Alrighty, great. So thank you guys all very much. I hope you guys enjoyed the presentation here and got something useful out of the methods that we discussed. Like I said, focused more so for those of you that are interested in swing trading options during the week. Nadex lets you do that. Most traders that are familiar with binaries but haven't traded them before don't even know that. So this is a really great way to help develop targets. You can do this on Fridays as well with weekly options in these names. Find the target and then figure out if it's something that you wanna trade. Really easy way to do it. And please make sure you check out our book here. It's completely free. It's a great indicator that you can use for trading binary options or anything else for that matter. So definitely check it out. It's a short read. It's less than 20 pages long, but very informative. So thank you, and thank you to Nadex for having me here. Everyone have a good one, and I will see you guys next time. Thank you.